Good morning everyone and welcome to this edition of Morning Markets. The backdrop in markets so far this year is in stark contrast to early in the new year of 2022, and this is despite no notable change in the narrative from central banks. So what's driving this apparent optimism, particularly in equity markets, but in broader asset classes so far in 2023? Well, the most powerful narrative that markets have latched onto this year is that of disinflation. This is the idea of a slowing in the growth of price pressures such that this will allow the measures of consumer price inflation that central banks are focused on to fall considerably from these record highs. And this allows broader asset classes to revalue higher somewhat on the expectations of less tight monetary policy as the year evolves. So the primary inputs into the inflation pressures over the last year have come from the commodity market, and those peaked broadly in the US, for example, in the summer last year, where a near 50% rise in the petrol price led to consumer price inflation in the US peaking at over 9% last summer. Now, so far in the US, inflation has declined by 2 percentage points, and this is because of primarily a fall in petrol prices of around 30%. So we can see that as commodity price pressures ease, and in some cases fall, this has a direct consequence to pull inflation pressures down. We also know that wholesale gas prices are no higher than a year ago. Now, this feeds directly into further price pressures downwards in the US immediately. A bit more noise in the UK because, of course, we have the price cap here, and our energy prices are readjusted every quarter now. So we've had one this month, and then will be April, October, so on through the rest of the year. But because of no price rise on the whole for the last year, this should ensure that these disinflation pressures build, starting with the US, but then feeding into broader Europe and the UK as the spring comes round. So this really ensures that this year will be one of disinflation, and it's really about how much inflation surprises on the downside that will drive the market narrative. So far, over the last 6 months, with the US leading the disinflation pressures, most of the inflation prints over the last 2 or 3 months have in fact been downside surprises. That is, the actual realised inflation has been lower than the market expected, and this has pulled these inflation pressures down quicker than was expected. And we have base effects. So because inflation was so high last year, as these measures roll out, it pushes inflation down even faster than we would perhaps expect. And this is what markets are focused on. So if we move away from equities just for a minute and focus on bonds, what does this mean for bond yields? Well, there's no change in the narrative from central banks, so we shouldn't expect shorter dated government bond yields to fall much because we're not expecting rate cuts. Markets are well conditioned for an end to the hiking cycle in the US and broader Europe as we end the winter and go into early spring. But we expect growth to cool, and that's why we're seeing yields on longer dated government bonds such as 10-year US Treasuries fall. That is, the price on these bonds is rising because of lower growth expectations, because interest rates have risen, and it's expected to cool the broader economy. So we've seen positive returns from government bonds so far this year, in stark contrast to last year when yields on government bonds started to rise materially, and so we saw heavy falls in bond prices beginning in January last year. So this is very important for markets, but particularly important for multi-asset portfolios such as those here at True Potential. We are diversified with equity and bond exposure, and these bond returns are contributing positively to portfolios, and so are equity prices. So what does this mean looking forward? Well, today we get the inflation print in the US for the month of December, so for the final month of 2022. And markets expect a further decline in inflation pressures, primarily because of base effects, so a large number from January 2022 drops out, but also because inflation pressures are cooling on the short term. It's expected that prices in the US may not have risen much, if at all, through the month of December, and that should allow inflation to decline to somewhere in the low sixes. So if we peaked at 9.1 in the summer, we will have fallen near 3 percentage points in just over 6 months. And markets are very forward-looking. They're going to extrapolate forward these disinflation trends through the rest of the year. And if we were to see a disinflation pressure build such that inflation could fall, let's say around 5 percentage points from where we are today, we could in fact have inflation back near target by the end of the year. That is, inflation perhaps could be close to 2%. And anything between 2 to 3% come the end quarter of the year would be very, very positive for markets, who would then expect central banks to acknowledge much lower inflation prints. So that's why so much of the market focus since the jobs print last week is now focused on the inflation print that will come at lunchtime today. So please do join us tomorrow, where our colleagues will update you on the market reaction and what we think that inflation print in the US means. Looking forward to inflation prints from the UK for next week. Take care.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.